Ladies and gentlemen, good day and welcome to the PDS Limited Q1 FY24 earnings call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Iqbal Khan from Nuvama. Thank you, and over to you, sir.
Hello. Good afternoon, everyone. On behalf of Nuvama, I welcome you all to PDS Limited Q1 FY24 earnings call. Today we have with us Mr. Sanjay Jain, Group CEO, Mr. Rahul Ahuja, Group CFO, and Ms. Reena Joseph, Head Corporate Finance, M&A and Chief Investor Relations Officer. Before I hand over the floor to management, I would like to highlight that the safe harbor statements on the second slide of analyst presentation is assumed to be read and understood. With this, I now hand over the floor to Sanjay Jain for opening remarks. Sanjay, over to you.
Thank you, Iqbal. A very good morning, afternoon and good evening to all our stakeholders across the time zones, and a warm welcome to our Q1 earnings call. There have been a bit of connectivity issue at this end, so if for any logistics issue the line drops from our end, just kindly stay put. We should be back in a few seconds, and I apologize if there's any inconvenience because of this. I would begin by saying that the performance for this first quarter should be seen in light of 3-4 key aspects. Firstly, the macroeconomic uncertainties have impacted on the demand scenario, as we have been mentioning it over the last 6 months, that the first 2 quarters of financial year 23-24 could be a bit choppy because of the market condition. Secondly, the Q1, in terms of seasonality, usually is our leanest quarter. However, the Q1 FY23 last year, on one hand I'm saying the Q1 is leanest. The Q1 last year also benefited from the tailwinds of the pent-up demand in a post-COVID restriction scenario. So these are a couple of factors that one should look at. And one more thing is that the Bangladesh operations, usually in the first quarter there is one Eid break and then there is a second Eid break in the second quarter. But both the Eid breaks, happened during the first quarter. It kind of increased the number of idle days for which the factories were shut. Our factories and also factories in general for production from about little close to 9 days to about 16 days or so. And we, however, have cautiously navigated, the last couple of months and anticipate to do so in a muted environment. But the good thing is that the signals that are coming in from our main markets wherein we operate, when UK and Europe are about 75% of the top line of the company, the signals that we are getting for a good anticipated recovery in the second half of the year have all started to, crystallize. It is also important that while on one hand the reported top line, which is largely coming in from the design-led sourcing business, has shown a decline, the gross merchandise value that we have handled during this quarter has actually increased 13% over the same period last year. And if you observe that the gross merchandise value that we have reported as part of our investor release is about 3,000 crore, whereas the top line of the company is about 2,100 crore. That means approximately 900 crores worth of business that we handled during the quarter actually is a contribution from the new initiative of sourcing as a service of the newly acquired Head Baker business. So therefore, this makes us feel that with the passage of few months, while the design-led sourcing business should bounce back because of the signals that are coming in, there is already a good contribution setting in from the new initiatives that we have taken. And the interesting thing is, on one hand, while there is a demand disruption that is there, but it is also unfolding into newer opportunities for us. We have earlier shared with you that sourcing as a service was one opportunity. We also mentioned about complete sourcing solution contract that we got from one of our retail customers in Germany. So therefore, company is actually gradually migrating the journey of being a solution provider to our retail customers, and therefore also building in businesses with higher margin. That's also one of the reasons that, amongst others, that gross margins have actually expanded, close to 2.75% in quarter as compared to the last year's same quarter. And of course, while we remain positive about the anticipated recovery, but we also have the lever in hand in terms of any cost optimization that we may have to do in the later part of the year. But at this stage, we remain very positive. During the quarter, we also successfully completed the acquisition of Ted Baker design business, and we are currently in the process of integrating it. And if I take the first almost 2 weeks plus, we completed the acquisition sometime in June month, and we already have achieved good financial performance. But before I come to the numbers from Ted Baker, the Ted Baker Design Group will serve as the global hub for the Ted Baker brand, and it will help us manage the global design and merchandising function. Further, this entity will function as a core licensee and operating partner for Ted Baker, having the wholesale business in the UK and Europe. So what I mean to say is, on one hand, there is a service fee that we are getting for handling the back end with respect to designing, merchandising and enabling sourcing, but at the same time, having got the wholesale business, these are the two revenue streams that are coming in from this business. While we spent close to about 150 crores, for which we actually got an equivalent amount of working capital in the business, we anticipate that, this business, we are gearing up, we are working towards annualized turnover of about, 475 to 500 crore in that range, broad range. And we believe this business has a potential of about, 7 to 9%, profit margin. So therefore, there is, from an ROC perspective, we are already forcing this business to be in the 30% plus range. And now, if I come to the first 15 days of the performance post our takeover, the business has reported 30 crore top line with approximately 9% bottom line, in the 2 weeks post our takeover. And another interesting aspect is that the Ted Baker acquisition, is actually leading to many more such opportunities now, before us. So if I rewind the clock from a Haynes sourcing as a service business, we actually saw Asta sourcing as a service business coming our way. And, we closed similar such contracts and got $1 billion worth of orders. And you saw a contribution of 900 crore coming in from such businesses in terms of GMV on top of a top line of 2,100 crore that we handled. And now the Ted Baker opportunity is a first step unfolding well in a silo in terms of its own viability, but also, leading to unfolding of many such opportunities. So therefore, in these turbulent times, while we anticipate the main design-led sourcing business to bounce back, the new initiatives are beginning to, contribute a lot to what we are doing. Now, if I come to the manufacturing capabilities, we've been as a very responsible PDS on the whole in terms of ESG compliances. We're going to make sure that our own two factories in Bangladesh keep embracing the highest kind of ESG governance standards. So we saw the installation of solar power panels in a Bangladesh factory, Green Smart Shirt, and this would enable us not only on one hand, go further the path of cleaner power, but also would lead to cost savings of annualized approximately 70 to 80 lakh rupees per annum. And about 12 to 18 months back, we had brought in a change in the leadership team of our factory Progress that actually has resulted into Progress Factory making money. We believe there was a need to also augment the leadership team of Green Smart Factory, wherein we have actually brought in a new team of CEO and a chief operating officer who spent close to 20 plus years in the industry, of manufacturing and selling garments to global retailers. So therefore, having achieved the turnaround, we want to make sure that there is permanency in terms of, making profits and then gradually taking up the curve. But as I said earlier, the manufacturing operation this quarter does have an impact of longer Eid break, and also on the whole, there has been a muted demand or so. So with this, I would hand it over to CFO Rahul Ahuja, and who will take you through the financial performance of the quarter for the quarter.
Thank you, Sanjay. Good afternoon and good evening to everyone. On the commentary for our financials for the first quarter, we concluded FY23 on an optimistic note, but we were aware of the headwinds in the coming quarters. For the quarter ended June 23, we reported a top line of 2,115 crores with a gross margin of 18.7%. Quarter one is usually a lean quarter in our industry. However, Q1 FY23 was exceptional as we benefited from the pent-up demand and reopening of economies post-COVID-19 lockdowns. Other than coming off a high base of last year, Q1 FY24 experienced a slowdown due to the global economic headwinds impacting spending power and demand, leading to an inventory build-up with large retailers and brands. We believe that this phase is temporary, with some spillover in Q2, and have a positive view for the latter half of this year. The muted demand enabled us to capture better margins. Gross margins have improved by 279 basis points from 15.9% to 18.7% quarter over quarter. We reported EBITDA for the quarter of 67 crores with an EBITDA margin of 3.2%. The EBIT for the year stood at 51 crores with a margin of 2.4%. Profitability, however, was impacted by interest costs mainly attributable to the increase in the base rate. Average SOFR increased from 0.7% same quarter last year to about 4.9% for Q1 FY24, approximately a 7 times increase in the interest rate. Tax outflows were primarily attributable to the profitability of companies, including Ted Baker, in the UK jurisdiction attracting a higher tax rate. As a result, in spite of operating profits being at similar levels as that of last year, our profit after tax witnessed a decline with a profit of 23 crore rupees. Revenue from our sourcing segment stood at 2,031 crores with an EBIT of 45 crores and a return on capital employed of 38% for the quarter. Our manufacturing segment reported a revenue of 117 crores and an EBIT of 4 crores. As Sanjay mentioned, given the Eid holidays, wherein both the Eids were in the same quarter this year, during the month of April and June, 2 of our factories were shut down for the holiday period, impacting our production base. Roughly, the number of holidays were more as compared to the same quarter last year by about 7 to 8 days. Moving on to our balance sheet, net debt stood at 26 crores versus 115 crores reported in June 2022. The reduction in our cash balances compared to our position in March 23 was mainly attributable to the acquisition of Ted Baker business that we did in June. We operated on a net working capital of 2 days. The company delivered a 31% return on capital employed and a return on equity of 27% for the quarter ended June 23. The company maintains a stable financial position with a net debt to EBITDA ratio of 0.06. We will continue on our growth journey by being prudent on operating costs and maintaining our balance sheet size to achieve higher returns for all our stakeholders. We will now open the line for any questions that you might have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. first question is from the line of Akshat Sam from Sam Capital. Please go ahead.
Hi, am I audible?
Yes, Akshat.
So, this is more of a broad-based question on our business models. So we have over 100 subsidiaries now and adding more every year because of our unique partnership model. But we also have a lot of multiple subsidiaries operating in the same geography. So basically, a lot of them maybe are competing against themselves to win businesses.
Sir, sorry to interrupt.
The question is,
sorry to interrupt, sir, but we seem to have lost the line for the management. It seems to have disconnected. Please stay with us. We will just reconnect with the management.
Sure.
Ladies and gentlemen, we have reconnected with the management. Akshat, I would request you to please repeat your question so that the management can hear the entire question.
Yeah. Hello, can you hear me?
Yes, Akshat. Sorry, apologies for that disconnection.
Yeah, sorry, sir. So just a couple of questions at my end. So the first question is more about our unique partnership model. So we have over 100 subsidiaries and we are adding more every year because of our unique model, as I said. But also there are a lot of multiple subsidiaries operating in the same geography. And they're like competing against themselves to win businesses. Also, aren't we better served by consolidating some of the subsidiaries that are, say, operating in the same geography, which will lead to more cost savings and other synergies? It will also help with management bandwidth where you'll have better oversight, handling a smaller number of subsidiaries in say, a particular geography. So, yeah, that was the first question.
Yeah, let me take the question then one by one. So on the subsidiaries, I think this is an inherent part of our business model, wherein in a normal company one would take an employee on board, and then kind of incentivize the employee, wherein we actually take an entrepreneur on board in lieu of an employee, and the entrepreneur actually has a share of profits, and this is very clearly identifiable in the hands of a prospective entrepreneur when he or she has a shareholding in that legal entity. So therefore, this is very much an inherent part of what we do, and how we operate, and this is likely going to be in a similar manner as we take along, because in a given geography, for example, I would say in Hong Kong, I have a simple approach business, primarily catering to customer Primark in UK, but then it's a design-led sourcing business. I have a business led by a gentleman called Eric Liddell in the name of Casa Collective in Hong Kong that focus on home category, And there's a third business led by Gaurav PDS Paris focus on Walmart. So that's the reason entities are existing. What is important for us as a management team is to ensure that the governance continues to be strong and keep going higher and up. That is where, as we learn from our investors, we are increasing constantly our disclosures in the top 10 verticals and so on, plus the strong board that came at the listed company level. We are also institutionalizing that board culture to the next level in terms of 10 largest verticals as well. Auditors are largely EY or GT across the various subsidiaries. So I guess, of course, in a company, in due course of time, There are some redundancies that you can address by optimizing some legal entities, but I think this is core to what our business is. But last point, we are very sensitive to the cost aspect that you mentioned, and at this stage, the central team that manages this entire, close to $1.5 billion top line and 2.5 billion GMV is about 1% of sales at present. And we are making sure that we don't allow it to go up. And in fact, all the CXOs that we wanted to hire in the central team is all done and using more of technology to take it ahead. So long answer to your short question, but I think it's important to kindly understand this is an inherent part of our structure through which we operate.
Okay. Thanks, Saurabh. Well, my second question is, we are trying to position ourselves as more of a solution provider to a lot of these companies. So, what other business segments within the clothing value chain are we looking to get into or expand the total addressable market? For example, we started sourcing as a service years back. And also, we recently got into a logistics company in Bangladesh. So is that a segment we are looking to expand into? And what other segments within the value chain we will look to expand into going into the future? That's it from me.
I think one more point, which is a little bit reflecting on the first point that you raised. Even our customers require a new entity to be put in place. For example, when Hanes signed up an annual sourcing as a service $400 million business contract, they wanted it to be run as a separate entity. In fact, the CEO there has actually a joint reporting relationship to Hanes as well as to PDS, so wherein the Hanes is actually able to see there's cost plus business. So that's also a bit of reflection on the first question you mentioned. Now on, yes, sourcing as a service, we believe from a concept stage 18 months back to actually it is now institutionalized. Our management team across the various verticals have got very much tuned to up to speed on sourcing as a service. So across all the relationships, this is being offered. And let me remind you that this is not something that I'm pushing. This is also the need of the customer as well, wherein the retail customers are actually wanting to focus on their core offerings, and they were searching for credible counterparties like us. So therefore, to that extent, it has become institutionalized. It is a constant that we will keep increasing now in terms of our offering. We went a step beyond. While sourcing as a service for Hanes was actually procuring from one geography of Bangladesh for them, but then for Gary Weber in Germany, it is not the entire global sourcing. So that's going up the value chain, and now brand management in Ted Baker. So therefore, if I got your question right, we would keep endeavoring on, a customer pain is actually my gain. So they want somebody to take care of the entire backend. So for example, Authentic Brands Group in US, they own a lot of brands like Reebok, Ted Baker, Forever 21. The annual revenue that they generate from these brands is about $25 billion. So when they are now acquiring brands, they're actually looking forward to an operating partner who works alongside with them. While they derive royalty, they want the operating partner to manage, the brand for them as well. So therefore, PDS is actually forcing a lot of such opportunities unfolding. So our core business of design-led sourcing will keep remaining intact, but the opportunity of value-added services plus new categories. In fact, about 1 year back, 12 to 18 months back, we have mentioned to our stakeholders that we've got into home as a category, and with our existing customers, we want to do that business. With Astra, one of our large UK-based customers, on one hand, this was a customer on design-led sourcing. We've got a $400 million plus of sourcing as a service contract, and we got a $250 million of agency contract for home business. Agency is the beginning of the journey, So that's the answer that, yes, we believe there is humongous potential now to engage more with the customers in terms of larger wallet of share.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good afternoon, sir. Sir, you said that this business is seasonal and hence explains the Q1 fall. But how do you see the full year FY24 growth trends as they are as of now, and if you can break it up between H2 and H1?
I think as we have mentioned earlier that we were kind of anticipating a single-digit growth throughout the year because as we said, the first 6 months would be muted and the next 6 months should see the recovery. So therefore, that's fair answering the question, kind of single-digit growth for the entire year. And I think we are, gearing towards making sure that somewhere profits should, improve closer to 15 to 25% for the entire year. That's the target with which we are working, in the year. And in terms of split in the H1 and H2, as we had said earlier, H1 actually should, it's anticipated to show a decline over the last year, but then H2 should see a strong recovery. So therefore, H2 quarter should be significantly better than H1.
So you're saying 15 to 25% in terms of profit growth for the full year?
I think I would say, optimistically, it may go in that range of closer to 20 plus or so. But I think if the demand doesn't improve, then the profits could be about 10% or so in terms of, I think there's nothing like an absolute number that we're working towards. We anticipate that range, that in a tough scenario about 10ish or so, but there is potential that it can actually go better than that as well as the recovery happens in the, second half of the year. But at this juncture, when we are talking to you today, all the signals are very good. Customers are taking little bit of extra time to close the orders, but the engagement level with the customer is very intense, and the signals are all very positive.
And the margin improvement trajectory that you have been guiding for 50 basis point per year, so sort of, that holds for even now?
Yeah, I think while notwithstanding closer to 2.75% improvement, I think a maintainable gross margin improvement year over year is, yes, 50 basis points. There is seasonality. While every effort is there to add more value-added businesses, but to one-line answer to your question, yes, we are geared up for 50 basis point improvement year over year.
Understood. And sir, on your finance cost now, there are two questions. First of all, in your business, when you say net working capital days is only 2 days, but if I look at your working capital debt, it almost comes to like 25 days. So why is there a difference between the two, and why, in a sourcing sort of a business, why should you carry working capital debt at all in your balance sheet? So if you can explain this discrepancy between these two figures of 2 days versus 25 days.
So, as far as our working capital is concerned, these are largely post-shipment lines. And, so we will always need, once we manufacture the goods, to finance our receivables. So largely, our working capital comes from there. As far as, our number of working capital days is concerned, if we were to, net off our cash position, the cash margin that we carry or the cash surplus that we carry in our balance sheet, if we net them off from our working capital, that's 2 days. If you were to calculate just the working capital, that is the number which comes more like 22, 23 days.
I think just to add to what Rahul said, I would say this is not a discrepancy, this is an opportunity. That operating working capital days length, yes, it is 2 days of working capital, inventory, receivable and minus payable days. And you rightly observed from a borrowing perspective, the number of days are much higher. We have not calculated, but I hear you, they are higher. So why is the discrepancy, or where is the opportunity then? The opportunity is that there is always cash in the system, on one hand, and then there's borrowing. And when we report net debt, we net off cash. But Rahul, our CFO, is close to about 27 years in the industry, and the first half of his was as a banker with GE and Standard Chartered and other leading banks. And I think a few of the areas that he has identified that our cash margins on the lines are much higher than what they should be. So therefore, over the next few quarters, we anticipate that the cash margins that is there should get released, and therefore the real debt utilization will actually come down. So therefore, what you observe as a discrepancy allow us to work towards as an opportunity to make sure that the debt itself is down rather than cash knocked off against the debt, and then we talk about net debt. So I think I agree with the observation. We would gear towards bringing it down in terms of the real utilization of debt.
And these are not the LCs that you are opening for your vendors. So are you taking any risk on their default on your balance sheet?
I think our LCs are, a very small portion of our procurement from the vendors. If I have to say circa approximately 20-25% or so. As we proceed during the call, Rahul can take the number, but that's the broad number of LCs being issued. I don't think there is any kind of default risk because every factory that we bring on board is taken on board with a comprehensive preceding 6 to 12 months of vendor onboarding process, and therefore we are in constant touch. We have a strong team of 800 plus merchandisers on ground. For example, if Bangladesh I pick up as one location where maximum number of factories are located that we deal with. So therefore, through our teams on ground, through our factory onboarding process, we believe, the exposure is low. And I think it is also well spread across. That's also an important thing that do I have a concentration risk on our given factory, and therefore there is theoretically a default risk. That risk is also, if at all we say there is a risk, low risk, that is also mitigated and spread across close to 600 vendors that we deal across the globe as well. So therefore, to summarize, careful onboarding process, being in touch through the on-ground teams. It is not that my designer team is sitting in UK and therefore they are through a remote control managing the factory. There are people on ground and well spread across. So the risk is well managed proactively, and the probability of it hitting us is extremely low.
So 20 to 25% of the entire sourcing is through is via LCs, right?
On a given point of time, that could be the peak situation that might be there, wherein we facilitate the factory in terms of fabric procurement or trims procurement, etc. in the value chain. But then I think the important thing is that on the front end as well, the customer profile is also carefully looked into. Is credit insured customer, track record, so therefore one should not look in a silo, in terms of the fact that I'm taking an exposure on the factory. The exposure is coming because at the first step there is an order that is emanated from a reputable customer with a track record. So that's how I need to request you, encourage you to look at the entire picture.
Thank you. The next question is from the line of Karan Premchand Gupta from Cavi Capital. Please go ahead.
Yes, thank you for the opportunity. I'll just take over from the last questioner and just delve a little bit deeper on when you're factoring your accounts receivable. Are those on a recourse or non-recourse basis to PDS?
Any given receivable is... Sorry, go ahead please. You finish your question.
Yeah, sorry about that. So what I was trying to ask is, in case the customer defaults, then whoever is doing the factoring, can they come back to you for restitution?
So our factoring is of two kinds. We largely do insurance-backed factoring, wherein the risk is taken by the bank. So the day goods are dispatched, we get our money, and the risk then lies with the bank because they have taken a back-to-back insurance. Largely, this is the facilities we have from our bank as far as post-shipment is concerned.
In fact, I would give the answer that the recourse to us is zero. It's under no eventuality that once the receivable is factored that they can come to us.
Fair enough. And then next, I just wanted to get a little bit more understanding about this acquisition of the Tech Baker business in the UK. Now, my understanding is that the total acquisition cost was about 150 crores, and you mentioned that this was all related to working capital. Now, it's a very sizable number given that you generally don't carry any working capital. So is there a plan or a timeline by which you'll be able to bring this amount, in line with the overall consolidated level and thereby, free up that capital, or how do you think about this?
Yeah, I think it's an interesting observation. Yes, we have upfront written a check of about 150 crores, and there is a corresponding working capital to that. And as firstly, even on as-is where-is basis, we mentioned about the anticipated turnover that we think this business could generate somewhere between 450 to 550 crores with about a 9%, circa 7 to 10 range profitability. So we anticipate that this business in year one should give us 30% return on capital employed on a 150 crore check that we have written. But the upside is that we are working towards factoring these receivables on a non-recourse basis. So therefore, it may take us about 3 to 6 months because the whole process of, getting the insurance in place, getting the factoring lines activated, it takes time, to get all these operational things on ground up and running. So as these things on ground takes about 3 to 6 months, there is a big chunk, for example, of receivable of approximately $16 to $17 million, which we got in our hand on day one. So if I talk about approximately, 60-70% of that getting factored, which is about $10 to $11 million, that means about 80 to 90 crore worth of cash would actually come back to us. 50% of cash, there's a potential, basis the existing practice through which we do our business of non-recourse factoring. So that's the answer to your question. In about 6 months' time, we are working towards trying to recoup this back through a non-recourse factoring program. Then that should hopefully even further increase the return on capital employed of the business as well.
Okay. So when you say 150 crores in working capital, is that all in receivables, or is there, a chunk of inventory, or what else is there in that working capital?
It's actually, for example, on a gross asset basis, there was about $40 million of assets, wherein the inventory was about 50%, about 20 million or so. There was about 16 to 17 million of receivables, about 1.5 million of cash. That's about 40, and there were current liabilities of about 20 million or so. That's giving me about 19, 20 million of net working capital. That's giving an answer to your question as to what is the breakup. And the inventory in hand largely belongs to the wholesale business that we have also got, a license to do as a franchisee. So therefore, this inventory would get rotated. And when we have taken the inventory on hand, we have taken due care in terms of diligence, and in terms of provisioning prior to we getting it into our balance sheet. So therefore, this inventory comes into our hands with a careful process. But I've answered the question in terms of breakup: 20 million receivables, 70 on inventory, 20 of payable, and only of wholesale business for which we are the licensee, and we will keep rotating it in the normal course of business.
No, that's very heartening to hear, and also thank you for discussing the inventory, how you went about looking at the inventory, because I was going to ask about that, so appreciate it. Finally, are there any other similar transactions in the pipeline that you can talk about, or if you were to come across something like this, do you think you would like to take a similar transaction forward, and what is your appetite for those? Both in terms of number of transactions and size of transactions. That's it from my side.
There are numerous number of opportunities that have actually got into the funnel, post PDS actually getting a success in sourcing as a service business and signing a complete sourcing solution and now brand management. A numerous number of opportunities have got. Many retail customers have actually got engaged, with PDS as a counterparty. And on one hand, I'm talking about retail customers. On the other hand, the likes of Authentic Brands Group, and there's a similar such reputable, private equity funded, well-funded, large conglomerates, companies in the US who acquire brands and they look for operating partners. So therefore, those are the opportunities that are actually getting up in the funnel with us. But having said that, we are very careful as to how we take them ahead. We are analyzing them carefully. I think the TED-Baker integration, Touchwood, has started on a very positive note. So therefore, for the next few months, I think while sourcing as a service contracts, we will keep signing up because the upfront investment is minuscule. But for any such brand management contract wherein there is a balance sheet allocation, I think for the next few months allow us to stay focused on TED-Baker, bring it to a stage that I mentioned that we believe in a 3 to 6 months time frame there is potential to squeeze cash out. That is where we would like to lock in, if all other factors are looking good into the next deal. But we are carefully engaged, focusing on TED-Baker, but at the same time now engage across customers. So it's looking positive at this stage, but cautiously positive because we got to, the initial 15 days experience of TED-Baker, we got to make it a habit over the next few months.
Thank you. The next question is from the line of Srinjana Mittal from Ratnatraya Capital. Please go ahead.
Hi, thanks for the opportunity, sir. So my first question is on TED-Baker. I wanted to understand the TED-Baker arrangement that we have with TED-Baker. So firstly, on the revenue stream, one sort of revenue stream is a fee-based model, if I understand correctly. It's similar to sourcing as a service. Is that correct?
Hi, Sanjana. Reena here. So there's two streams, right? One is where TED-Baker, all the distribution partners, right, have to procure the merchandise for the categories that we have the license and the design team of. So whenever they procure it, they have to route the order through us, where we do the design and the other elements. And on that, get a service fee, right?
Okay, understood. Yeah.
Person agreed upfront as part of a buying agency agreement with them. Other than that, have a wholesale business where for UK, Europe, we will be taking the product in our books landed in UK and then distributing it. It's largely pre-sold, so we're getting the orders, getting the product manufacturers, getting the products to UK and then sending it to the distribution partners. That is a higher margin business where I get around 35% plus margins. And then I do a marketing spend, so on and so forth. But the design team works across both the agency business or the design services and as well as the wholesale business. So the same team, two streams of income.
Understood. So just so the wholesale business, we'll be taking the product, products on our books. So that means that would be all on a pre-order basis, or we'll also keep some inventory and then sell it. How does that work?
Yes, it will be on a pre-order basis where the distribution partners, the retailers, currently actually coming and visiting the TED-Baker office. They are looking at the merchandise and the next season's stock. They place the order and we get it manufactured.
Understood. Okay. And the 30 crore revenue that we generated, that's a mix of both the streams, and for the service, the fee one, it is the fee component of that, right? That's
correct. That's correct. But the largest chunk of the 30 is actually the wholesale business. If you see, because a larger part of it is on the wholesale side, and yes, the fee that comes, that also is part of the sales.
Understood. And like on a full-scale basis, what is the expectation revenue potential? I think last Concall was mentioned around 1,900 million pounds, if I'm correct.
Yeah, I think we would be kind of conservative for a first-year aspiration. So we believe somewhere around 475 to 5, upwards is what we should get in the first year of operation. And we're looking good to get there. And also, just a point to add to your initial question, which Zina answered, for the wholesale business, the kind of check that we have written upfront, 150 crore or so, is the investment that actually has gone upfront. So we would be now leveraging it, rating it over a period of time, kept rotating it to generate that kind of wholesale business turnover. So that's the kind, and on which we mentioned about a potential 30% plus ROC. And thirdly, the ability to squeeze the receivables out through non-recourse factoring over a period of 6 months. That's where the business stands.
Understood. And also on the last call, I think we mentioned a new contract with Jerry People. Where are we on that? Can you shed some light on that?
The contract is signed, and right now it is being operationalized, so therefore, the integration process is underway. So I think it should start contributing to our top line from this particular quarter. So to answer the question, contract signed, execution integration process underway, and we should see it start contributing to our business from this quarter.
Understood. Very interesting. Thank you. Just one last question. So gross merchandise value, which you mentioned, is around 3,000 crores. So that includes sourcing as a service as well, right? Like the merchandise that we handle for sourcing as a service, but eventually in our revenue, the service fee portion comes. So that includes that, right?
Yeah, I think, yes, 3,000 is the GMV, 2,100 approximately is the top line, so 900 crore is the, GMV. And I think the commission that we got is approximately 41 crore, plus minus a little bit here and there is the number that we got from this 900 crore. There's approximately 3.5-4% that we earned, from as an average number from handling this sourcing as a service and similar such contracts.
Right. And for sourcing as a service, what would be the merchandise value that we handle for this particular quarter? So you so 3.5% out of, and 40 crores is the revenue that you got. That's.
To further give breakup, when I said 900 is a difference in GMV and sales, so that 900 approximately has about 75% as the portion under sourcing as a service, and 25% are the agency commissions that we get from customers. That's kind of been going on for a while. So therefore, specific to your question, 75% of 900 crore is the GMV that we have handled in quarter one from sourcing as a service contracts.
Okay, sir. Thank you.
Thank you. The next question is from the line of Iqbal Khan from Nuvama. Please go ahead. Iqbal, the line for you has been unmuted. You may proceed with your question.
Yeah, hi. Sorry, I was on mute. Can you hear me?
Yes, you're audible,
yes.
sir.
Yeah, hi. So my question is on the, income statement only. See, on gross margin, we have done well, right, around 280 basis improvement. However, EBITDA, so gross profit actually increased by 6% YoY. However, if you look at EBITDA, it has degrown by 9%, majorly because of the employee expense, which is now contributing around 9.5% of the revenue. Right. So just wanted to know why, what was this 14% growth YoY? What does this comprise of? If in case had it been in the range of 8 to 8.5%, the EBITDA margin would have looked, similar to what we had done in Q4. Right. So just wanted to get a sense on this, on the employee expense.
I think if I get your question right, when we talk about 4% plus operating margin that we achieved in quarter four last year, quarter four is usually our best quarter. One is getting an opportunity of achieving the highest sales among the 4 quarters, and therefore the costs are actually getting amortized over a larger base. And quarter one is usually the leanest quarter, and therefore the margins are about 3.2 or so. And now I also mentioned that the last year first quarter also should have been the leanest, but there was a pent-up demand benefit. So pent-up demand overcame the lean factor, and I think if I recall, we were at 3.1, 3.2 last year. But despite the sales fall, the benefit of better margins, gross margins, whether they are coming in from procurement efficiencies, whether they are coming in from better margin business, proportion the top line increasing, or the entire value chain, all the way of replacing order to third-party factories, or even the cotton yarn prices, fabric prices declining, is all benefiting. So therefore, these 3-4 factors have actually benefited. And as things unfold in the later part of the year, we believe the sales traction should give better results. Number one, there should be continuation of revenue and profit from the better margin business that we have got added in the trajectory. The procurement centralization effort should keep adding as well. So therefore, we believe that what we achieved in quarter 4 last year in terms of 4% margin, all indicators are that we should, get back to those levels in quarter 3, quarter 4, and hopefully improve thereafter as well. And other thing also is that I think the entire industry, all industries in India and across the globe have been getting impacted by the interest rate cycle. And as our CFO Rahul was earlier saying, that there is a 6 to 7 time increase in the base rate, this quarter versus last quarter. So therefore, somewhere I think we all anticipate in about 2 quarters the interest rate should peak and therefore start coming down as well. So therefore, below the EBITDA level as well, we believe, in the later half of the year, more so towards quarter 4, when all of us in the industry should see the benefit of interest rates beginning to come down as well. So these are some, as I said in the beginning, I hope I got your question right, and these are some of the factors that could influence the gross margins, the EBITDA margins, and also the PBT margins.
Understood. Fair enough, sir. Thank you for addressing this question.
And I think somewhere when the first question came about the legal entities, and wherein I mentioned that this is our inherent model of having entrepreneurs on board, and why I'm bringing that point again, that there is an entrepreneur in a business like a hawk, working very closely, keeping a close watch. Therefore, that ability, that agility to actually prune down costs as well. In case, while we're all anticipating recoveries are here, happening hopefully in the second half of the year, but therefore, the first point that I answered on the legal entities, also there's a plus of that in case the situation continues to be very tough, very unlikely, but if that is the case, that lever exists, and that entrepreneurial fabric of the organization will also see that an initiative taken from the corporate is executed in a very shorter span of time in terms of bringing the cost structure down as well.
Thank you. We have the next question from the line of Amit Doshi from Care PMS. Please go ahead.
Yeah, thank you. I just wanted to understand once, this slide in the presentation where, the financials are there, and it's mentioned that the gross margins is improved because of better pricing due to lower demand. Can you just help me understand that part?
Yeah, I think it's an interesting English written over there. What it means is that on one hand of the continuum, you have the retail customer. On the other end of the continuum, say you have a factory. And of course, the end of the continuum also goes where to go to fabric supplier and so on. And we are in between, adding value to our customers, channelizing orders for our factories. So the factories are, kind of in a serious dire situation across the world because of the demand being low. They have been severely hit. So therefore, they are clamoring for orders, even at low margins, so that they can fill in their factories. So that's where, if the demand is low, if the orders that they are getting are slowing down, then PDS as a solution provider in between is having the ability to generate orders, and therefore sit down with the factory and say, yes, the orders are there, but then let's discuss margins, And I think we are, as a responsible company, we are not trying to unnecessarily squeeze the factory. We also got to be there that there there are mills at the back end supplying fabrics and supplying trims as well. So that also in turn is the entire value chain, I think, is wanting to make sure that in a muted demand scenario, let us make sure that there are orders and there is recovery of fixed cost. Let's keep floating for better times to ahead. That's the premise behind that statement, that in terms of a low demand is actually also translating to a better margin scenario.
Okay. So the difference that you negotiate, you keep it with you rather than fully passing it on to the ultimate customer.
No. Our endeavor is always to pass on the full benefit to our customers. It's, in fact, the customer decides the price, but then we very humbly work towards the back end. For example, I mentioned that we also have no centralization of procurement, and I think I have to admit that I'm away from the eventual retail customer. So therefore, there will always be an ask for my customer to bring down the prices. So I want to make it very humbly there that I don't want to be seen that somebody who's going to increase prices or not pass on the benefit. But very importantly, I need to keep adding better margin revenue streams in terms of my engagement with the customer. That is how we believe that through my centralization of procurement, through my augmentation of trajectory on better margin categories, that I go back to the statement that we anticipate average 50 basis point improvement in margins year over year.
Okay. On the manufacturing front, of course, there is a significant reduction. You also mentioned about the Eid holidays and the resulting lower production. But I'm sure that was expected. So accordingly, the inventory would have been maintained. So this is purely a reason of lower demand only, or this Eid holiday has something significantly to play with this reduction in the manufacturing operations?
I think there are two external reasons and one internal that impacted the manufacturing in quarter one. One is the Eid factor, which is a critical factor. It's almost a 1 week of sales, production and sales from factories. That's number one. And number two, our factories have been on an average somewhere 50 to 65% range doing direct business with the customers, by the remaining coming in from our internal sourcing verticals. So therefore, while the demand, or the orders for any factories are getting impacted, they also impacted our factories as well to the extent they're doing direct business. The third factor, which I mentioned, in the opening remarks, is that we did a change in management in a progress factory, the bottom factory, and we did the same in the beginning of the quarter one in a green factory as well. That's taking a bit of time to, stabilize. So that's an internal factor. So this is the answer to your question as to why our manufacturing top line actually came down in this quarter.
Okay. Regarding this Ted Baker transaction, you mentioned this is 9% bottom line. So when you say bottom line, what exactly that means? Is like a debit, EBITDA, or PAT level? And in our books, so is it recorded in other income or it comes in the top line? I mean, how exactly it gets reported? So that 40 crore part that you mentioned.
9% is actually the PAT from the Ted Baker transaction, and 9% is the actual achievement. But as I said earlier, somewhere the full year horizon is about 7% upwards for the entire year. And as Reena was explaining in response to one of the earlier questions, to the extent of our top line was about approximately 30 odd crores in the 15 days. The bulk of it was actually the wholesale business. That's actually gets recorded because we purchase and sell, and the commission or the service fee that we get on the design service or the sourcing service that we provide, only the service fee portion gets added to our top line. But the combined impact of that is 30 crore top line, and the combined impact of that is circa 9% PAT in the first 15 days of the acquisition.
Okay, so it doesn't come under other income?
No.
Okay. And this tax rate for this quarter is slightly higher. It's just what I understand that we have to look at the annual figure, but just to confirm, there are no changes in the any tax bracket that we fall into or anything of that sort.
I think, Rahul, you want to answer that? Go ahead.
The tax.
Why the tax rate is higher?
So the couple of reasons for why the tax rate is higher by about $200,000 in the quarter. One is the profit of Ted Baker being in the geography of UK where the taxation is higher. That contributed about $100,000 out of the 200. And the second reason is in Bangladesh, the government from July of last year changed the taxation wherein earlier it was 0.5% on the collection of receivables. Now it has become 1% on the collection of receivables, and that contributed to the balance about $75,000 to $80,000. So these two reasons largely explain why our tax was marginally higher.
Okay. So, sorry, 1%?
Interrupt, sir, but for paucity of time, we need to proceed with this conference.
Sure.
Okay. Thank you.
Okay.
I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Ladies and gentlemen, thank you so much for joining us. It was a pleasure to have an engaging audience like you, and we look forward to connecting with you again in near term. Thank you so much and stay safe, all of you. Thank you, Nuvama team, for organizing a conference call. Thank you.
Thank you. On behalf of PDS Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.